Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, is this the pause that refreshes in the stock market before it moves higher, or is the market losing steam altogether? Our analysts weigh in here at the roundtable. There's editor-at-large Steve Reitmeister, senior market analyst Charles Rotblatt, and top market technician Kevin Matris. So I guess that's the question on everybody's mind right now. Is it over? Is the rally just lost its steam?
Well, I think in terms of steam, it definitely has, and one of the things you can look at is volume. And there's a lot on this chart, but if people look right there at the little orange box, you can see that volume since April has actually trended down, and we're running below average. We're running below the levels we saw October through March, and that's just a sign that the bulls have lost conviction. Obviously, if you're bullish, you would also argue, well, the buyers haven't exactly wrestled control either. But I think when you're looking forward, you have to say, okay, what's going to drive the market higher? We're not going to have positive earnings estimate revisions because earnings season's over. We're not going to have the stress test results because we know everybody passed. So you're kind of looking, well, what could we have that would really drive the markets higher? You have GM, if that gets resolved, peacefully and neatly, and that's a big question. We'll know very quickly because the deadline's looming. We still have the banks trying to finagle their way out of TARP, and we don't know what kind of restrictions the government's going to put on them. Then again, it's another negative we're looking at. And finally, you have the economic data, and people are saying, well, maybe the economy is stabilizing. And although the economic data is showing the economy deteriorating at a slower pace, all data still shows the economy getting worse, not better. So I think what we're looking now after really 8 weeks of gains, 8 gains out of the last 10 weeks, I think we're in a situation right now where the rally has run its course. We're overextended and we're overdue for a pullback. And I do think that's going to come over the next few weeks.
But unemployment, a key indicator, weighs in here. And I'm reading that consensus on the street says that we're at the top of the unemployment rate. Do you buy that?
No, I mean, even after you see the economy start to rebound, we'll see unemployment rate rise. Companies will continue to cut jobs. All I'm seeing across the board is companies, we made our numbers this quarter. We beat our numbers because we cut costs. They're going to continue cutting costs. Companies are very worried about what the future looks like. So we could actually see the economy itself recover and still see unemployment rate rise. Right. I think it's very likely we will see 10% unemployment or higher. Okay, so Kevin, is this that sideways movement that Charles have been talking about for the past 2 weeks?
Who knows?
Well, thanks.
The one thing I want to talk about what Charles said. It is true. A lot of these companies, they were able to show better than expected earnings, and it was because they were able to cut costs. You're not seeing this on the top line. And I think it is imperative that you start seeing these companies improve their revenue in order to be able to catalyze this market higher. But is the market losing steam? Yeah, it is kind of losing steam. But what's interesting is that every time the market does look like it's going to truly let off a lot of steam, it starts building steam back up.
Right.
And logically, the market should go down. The earnings on a year-over-year basis have been terrible. The valuations are significantly higher than where they have been in previous months. And as Charles had said, too, the most disconcerting thing with this recent rally is that it has been made on declining volume, and that is never a good thing. That shows that you've got a lot of people who are unwilling to participate. But just like the oil market was able to blast up to 150, yep, and the fundamentals could not support that rally, it is very conceivable that you could see the market test this upper end of its range. So,
Steve, you're my last hope. Are you in the feel-good camp here?
I like to think that I'm a realist, okay? And so when I take a look at the information, probably I was the most bearish last year. Charles coming in a close second with me for bearishness. But I believe there's a good reason why the market rallied up from 6,500. I believe that if we take a look at the earnings picture for 2010, it has stabilized. In other words, the estimates are no longer declining, as Dirk Van Dyke pointed out in his most recent article, that the earnings estimates, take a look back over the last, say, 30 or 60 days, that they're not dripping lower anymore, which is a good sign. So if the earnings estimates for 2010 are realistic, then the current market valuation makes sense. Going too much higher than this doesn't make that much sense to me, but I'm not seeing a reason that we have to retest 6,500. Shooting down to 8,000, 7,500, that's always doable, playing in a range. But I believe that, here again, this is the pause that refreshes, that this is a healthy consolidation, but not necessarily a consolidation to spring higher. You have to consolidate to eat, to digest what the market's already eaten.
Right.
And stay in here until we have that more important impetus, whether that is corporate earnings, whether it is true improvements in the economic outlook. Right now, we've made enough of a move, I believe.
So Kevin, what do you expect to see here going forward over the near term?
Like Steve had said, the market going sideways actually could be considered a sign of strength, or at least that's how I interpreted what Steve had said. But the market had been overbought. There is no question. But aside from going down to correct that overboughtness, you can just simply go sideways. And every day the market doesn't collapse, you are building a bigger base conceivably from which to go higher from. So if you were to look at the dump, I've said it before, if you were to look at the dump that you had seen in February and March, that had been flatly rejected, and you can now, in hindsight, say that the market got way ahead of itself to the downside. The world was going to end. This is where the market should have been. Mm-hmm. Now, if you were to take a look at where we are, I think the market has the ability of retesting the highs that we saw in October and November, because you can say, is the market better now than where it was back in October and November? And the fact of the matter is, in October and November, everybody thought it was going to get crazy worse. So you can say the market is significantly better than where it was back then. And if the market is better and if the economy is better, shouldn't it go back to the prices where the stocks were at back then? So I think that is the high end of the range. You had this 65 or 75, wherever we were, low. Then you had the almost 10,000 on the high. I think that you could ultimately bust out of this range and go back to the October, November highs.
All right, Charles?
It's interesting. As we record this, the VIX is now trading near 30. There definitely has been a change in risk tolerance.
Right.
We're seeing in the credit markets, we're seeing in the equity markets. So I do think people are getting more accustomed to the economy, and I think some people are starting to bottom fish. However, there's a lot that could go wrong, and it really just takes one shock right now to send the economy in a far worse situation than we're in now. So I think it's pretty questionable. Although I am in the bearish camp and I do expect a pullback, I do think that pullback could be a good buying opportunity. And I do think people need now more than ever to look at the markets. And I know the next downturn, it's going to scare some people, and some people are going to use it as an excuse not to look at stocks. But I think now, probably more than ever, now's the time to really do the research. If you're not subscribed to Zacks or one of our competitors, I really think it's critical, because on the next pullback, it could actually end up being a buying opportunity that we won't see for years to come. I don't expect a huge rebound coming out of it, but I do think we could see valuations at levels that would be very attractive.
So now you're looking for pullback, not trading range.
I think we'll get a pullback over the near term, and I think that could settle into some type of prolonged trading range, but I think we'll see a rotation in sectors, which could create some very good buying opportunities.
All right, I just needed to clarify that.
That's
you notice they agree with you only because you're sitting here.
Yeah, when I walk away watching them change the tune. As far as, if I play on Charles' thing here a little bit, I don't think people have to wait for a pullback to be in this market. What I'm saying is, there are some decent values right now that even if things do go lower, looking out 6-12 months from now, they'll be glad they have it. There are some good names that I believe have overextended themselves. Your Apples, Googles, some of the other tech names, I believe, running up from, like, say, let's just take Apple, for example. Great company, but going up from 80 to 125, 128, where it is today, 128 is no longer a bargain. You see that pull back down to 115, 110, that's an attractive entry point. So there are reasons to be in the market today for the long-term investors, meaning the worst is probably behind us. But are we due for a pullback? Yes, a little bit. I think within a range, I think that we can, 7,500 maybe at the worst, 7,800, 8,000 might be all we need to hold on the downside. And so getting something 5, 10, 15% cheaper, yes. But don't just hold out for that. People should be in this market and selectively pick the stocks when they think that this is a good enough price for the next 6-12 months.
And you bring up a good point. There is still a lot of cash on the sidelines.
There is a lot of cash on the sidelines. and some of that has been reallocated, and some of it fearfully outside the market. I would say, which is fine. So when they see when they see that all is well out there, they'll come in. But right now, it's not all as well. All makes sense right now. Don't rush higher. Don't rush lower. Let's get some of that second quarter data flowing and see what we really have in terms of earnings and the GDP. And hopefully, it's a cause for further upside.
All right.
Hopefully.
All right, that's the latest weigh-in here. You are done, right?
Yes. Hopefully.
I just have to be sure. That's the latest weigh-in from here on the markets. And if you're accessing this video from outside of Zacks.com, don't forget, you can always go to Zacks.com for a lot more interesting commentary on earnings and the markets. With Steve and Charles and Kevin, I'm Terry Ruffalo.